session titled Together We Can, Unravelling Exits. And to chair this session, we have Ms. Vamshi Krishna Reddy, partner at Kalaari Capital, Mr. Vikram Gupta, founder and managing director of Ivycap Ventures, Naiyya Saggi, co-founder, the Glamm Group and founder, BabyChakra, and Dr. Ritesh Malik, founder, Nebula Holdings and co-founder and trustee, Plaksha University. Welcome, Vamshi, Vikram, Naiyya, Dr. Ritesh. Over to you, Vamshi. Hello, Vamshi. Over to you to start the session.
Thank you. Welcome, everyone. Good afternoon to the TiEcon Unstoppable India. Together, I think today we are going to really discuss about unraveling exits. We have a great panel here. We have Ritesh, Naiyya, and Vikram. I'll just go ahead and quickly introduce them. Ritesh doesn't really need an introduction here. One of the early exiters from being able to find a company and actually get a quick exit, I would say. He has been the CEO of Innovate, which was a co-working space startup that was acquired by Oyo. Currently runs Nebula Holdings. Naiyya, again, a veteran, I would say now, a part of the Glamm Group. Started BabyChakra, which was is India's fastest growing, largest platform for pregnancy and childcare, which was later on acquired by Glamm in 2021. She's the co-founder of the parent company, the Glamm Group. Vikram, of course, comes from the venture capital side, founder and managing partner at Ivycap. Some of the notable investments include Purple, Clovia, and Biryani by Kilo, and many more. So given that we are running a little bit, I'll just jump into some of these things. The last 1 year, I think, has been exceptional for Indian startups. I think they've raised like significant amounts of capital, which is around $42 billion. It's up almost 3x from the previous year and saw close to around 46 unicorns, which happened, right? And a total of around 11 Indian startups raised $7 billion through public offerings. That also has been something which has never happened, basically, right? Especially from the startup world as such. And we've seen several different exits across the PE and VCs, worth over $43 billion through 280 deals in the last year. And these came through several different modes. Some of them are secondary sales, and we've seen the M&As was the highest in 2021. So with companies and ecosystem maturing, I think the trend is expected to continue to offer liquidity at an early stage. Over 27 secondary exits happened for the Indian startups in 2021, which provided an aggregate exit of almost $1 billion. So let's start with, because we at Kalaari always talk about CXXO and women first. So we start with Naiyya. So Naiyya, you started BabyChakra back in early 2015 and have grown the company incredibly well, and leading to an acquisition by the Good Glamm Group. Um, Now you're part of the Good Glamm Group, but just wanted to understand, what your journey has been, and how and what thoughts you have to share in terms of how you've configured your journey in terms of when you would like to exit, right? Because there's a common problem which an entrepreneur struggles with. So just putting an entrepreneur hat and thinking, across different opportunities which you have seen during the life cycle, what was the moment which made you feel that, hey, this is the time I would really like to think that I should exit? And generally, I would also request you to maybe throw a little bit of time on talking about what you think is the right time to exit.
Thanks for this, Vamshi. As an entrepreneur, of course, you don't start your company thinking of exit plans, right? I think that comes much later. That said, I think and it's very interesting because I've sort of seen the journey out for the last 6 years, right? And I think apparently there's been a very strong maturing of the ecosystem around us as well, right? So something I think we picked up along the way of building Baby Chakra was more of us were specialized, right? So Baby Chakra was very hyper specialized in content and community building, which we did a fantastic job of, right? So we scaled about 25 million mothers, 10,000 doctors, built up what is considered globally as one of the strongest communities for motherhood and childcare and pregnancy parenting there is, right? But while we were specialized in that, the whole pathway to actually building a value, creating business in the traditional term, right, really being cash generating, was something we always felt would come through products, which is why I think the conversation with Darpan was a really important moment in our lives, right? Where we said, okay, we have the specialization in creating communities and content and how to engage deeply and retain deeply large user cohorts, right? We can plug and play into the MyGlam ecosystem and basically start creating products at scale for the mom and baby care space, right? And that, of course, has its own journey and its own story of very strong tailwinds. So I think, while I'm just sort of using my journey as a very small micro example, I think the journey you see play out across the ecosystem of specialization, of maturity, and of actually plug and plays that come together to create value larger than just like, individual parts. So I think that's been our journey at Baby Chakra.
Great, great. So let's just quickly jump to Vikram here. Vikram, you've been on the venture capital side, and I think you had a very, very successful year last, because I think that's been the case for a lot of the funds. So, you made some substantial exits in the last 1 year. You exited from Purple, Lexer, FarmRack, and recently from Clovia. Given that, there may be different time horizons and expectations of returns for exits targeted by founders, just like what Naiyya was saying, how do you look at it from a venture capital's standpoint and ensure that you're aligning everyone's interests together, right? That's also a big challenge. So how do you look at it?
Thanks, Vamshi, for having me here, and thanks for that question. So I think that's a very, very fundamental question that, as the entrepreneurs start raising their rounds, starting from their seed to Series A to Series B, interestingly, different investors come on board, and different investors typically have different philosophies of exits, different expectations, and every time a new investor comes on board, they typically have their own definition of how they perceive exits, etc. So it becomes increasingly difficult for entrepreneurs to manage everybody's expectations. Therefore, what we recommend to entrepreneurs is that, first of all, get their own vision alignment in terms of how they look at the long-term picture, select their investors based on their long-term plans rather than just somebody comes with a check and just because they're getting the valuation, they should just take the first such deal. So they should always look at the exit aspect of the investors before just taking their money, because we've seen scenarios where time has come for investors who have invested for a period of time, and now they're looking to exit. And the investors who just came on board, let's say, a year or 2 years, they have much longer term horizon, and now they are still looking at the company from a very long term perspective. So their entrepreneurs have to be very, very careful in aligning the expectations right at the board level and also at individual investor level, especially for investors who are substantially larger on the cap table. We have been quite successful, as you said. Last 1 year, we made quite substantial exits. Purple, we had invested 15 crores in 2015. We sold our stake for 330 crores, which was actually a secondary sale. Then we sold our stake of Clovia this year from both Fund 1, Fund 2. We sold the company to Reliance, which is also very profitable exit for us. And so far, our journey has been great from exit perspective.
Thanks, Vikram. And I think that also brings to one of the questions. As a founder, I have always struggled, because one thing I've never read in the detailed documents is the fund life cycle, right? And most of the times I realized that we didn't even understand what a fund life cycle means until you hit the end of the runway and you suddenly realize that this is how it works. And I personally known that what a fund life cycle means after that. So that education, I've seen that is not with the entrepreneurs for most of the time, where they don't realize how different investors fund life cycle works, so that you can actually align some of those things. And this might be more of an education, right, than anything else. So carrying on that, I think just coming back to Ritesh. Ritesh, you're here?
Yeah, I am. Am I audible?
Oh, okay, good. We lost you for a bit, I think, in the early
Yeah.
part of this. Ritesh, again, as we were talking, Ritesh has done a successful exit to, Oyo very early on. So one of the things is, I know, Ritesh, you were kind of building a great company. What made you feel that, this is the right time, right? And what made you feel that, instead of going the long haul, this is the right thing to kind of do at this point of time? Is it personal? Is it more venture VCs driven, or is it more like opportunity driven?
Great. First of all, massive thanks to Ty for actually touching this topic. Very few people talk about exits, and grateful to you, Vamshi. I think the questions that you mentioned are phenomenal. So coming to the point that you never sell your business. The whole idea is that's not in your mind. As Naiyya rightly said, you never sell your business. You start a business with a vision that you're going to go IPO, and IPO is just the brink of the journey, and you will eventually build an extremely large business. That being said, I think selling is a byproduct of continuously trying to raise capital, continuously helping your customers achieve their goals, continuously focusing on NPS, and continuously being present in social media. This is what I feel. Like example, we never thought that we will exit the business so quickly. It was hardly, I think, 2 years and some 5 6 months from the time I registered the company to the time that we signed the term sheet for selling the business to Oyo. So I personally never thought that we will do that, but we always wanted to raise capital. The day Ritesh messaged me, he said that we would love to we would love to be a part of Innovate. So we were thinking that we will raise significant capital from Oyo and then eventually do that. But we realized that and fortunately or unfortunately, there was not even a single Series A investor in the country who wanted to invest in my business. So because of that, at the time of exit, I held majority of the company, except of Y Combinator and a couple of small angels like Vijay. I held the company completely with me. So I had the liberty of making the decision, as Vikram rightly said. At times, having a Series A investor on board, his aspiration, because the aspirations need to be completely aligned, especially for making that decision for exiting your business. Apart from that, one last thing which I would like to put here is that entrepreneurs need to be very clear about why do they want to sell. and they need to be very clear in what form do they want to sell. Today, I can openly say that the world's largest co-working player back then offered us a valuation which was some 2.5 times of what we got from the current suitor. But we were very clear we wanted to do an all cash deal. We do not want to have we did not want to have stocks, and that's not because those companies aren't great. They're amazing companies. I'm a massive believer in all these companies, but it's a personal choice that at what kind of an exit do you want to have, what kind of and also while exiting, it should not be only the founders who benefit out of the exit. It should be especially the employees of the organization. Now this is very interesting. 28% of M&As are successful in the past 50 years of histories of M&As happening, and there's massive layoffs when these kind of deals happen. So ensuring the right interest of the customers, of all the stakeholders, especially your employees, is extremely important while making that decision. And I was very clear that I do not, because while when you sell a business, there's a lot of lock-in on the founders. I was very clear I would rather have a smaller valuation but not give a lock-in more than 6 to 8 months.
No, I think that's a terrific point, actually, Ritesh. I think, personally, I know that in my journey, I've come across opportunities where, 2, 3 years into the company, that there is opportunities which come across, and most of the times you are struggling to decide as to whether this is the right exit for the founder or is this the right exit for the investor, right? So there's a dilemma between, is this a good exit for a founder or is it a good exit for the investor? I personally felt that those opportunities sometimes change drastically over the period of the course of the company. Either they become large or they become very small compared to what you might have observed earlier during those journeys as well, right? So that brings us to the point, to you, Vikram. When you are actually coming in as doing an investment, when you're negotiating on the priority order of methods of exits primarily, do you look at secondaries versus buybacks versus M&As versus IPO, right? What form of exits are giving better outcomes to investors in the current scenario, right? I mean, of course, we've seen there's a lot of sectors happening, but we'd love to know your thoughts on what you're seeing.
Yeah, so I think there are two questions in that. One is at the time of investment. Obviously, there is no. I mean, it's only a hypothesis that how you're going to exit, right? So it's a little sensitive discussion as well with the entrepreneur, as both Naiyya and Dr. Ritesh mentioned that entrepreneur building their business for very long term, and an investor comes and start this exit, right? So there itself they start really seeing the situation very differently. The interests start getting slightly misaligned to begin with. But at the same time, the entrepreneurs, especially when they're raising the first check, is the time when they realize that yes, that's an important thing. Otherwise, they won't be able to raise that capital. And typically the way we look at these things as investors is first we first of all want to make sure our exit is completely independent of any other events. It is not subject to any events. It should not depend on any other things happening. So because we are managing third party capital, we don't want to depend on any other things. So we should be able to sell our stake without having to take any permissions from anyone. So we don't agree on any kind of somebody wants to tag along with us, etc., while we are exiting, which adds burden to our exit. So obviously, eventual goal would always be, an ideal situation always would be to take the company to an IPO stage. But if you're coming at a Series A level, IPO would be far fetched. The time required for the company to prepare for an IPO might be much beyond your time horizon for the investment, which is typically 5 to 6 years. So therefore, you look at what is going to give you the most optimal return. Typically, an M&A is something that we've seen gives the most optimal return from the investment perspective, because if the company is scaling up and is attractive to somebody else to buy, they'll be happy to pay a premium at that point. So therefore, they sometimes even come and pay you value which you may not have expected otherwise. So that's an optimal exit that we look for. But at the same time, that may not necessarily be the optimal exit for the entrepreneur, because for them, they don't know, when somebody is coming with an M&A mindset, how they're going to look at the entrepreneur themselves. So in that sense, there's a slight misalignment. But obviously we negotiate the terms in such a way that if an M&A has to happen, if you're getting a good deal, the entrepreneur will be aligned. So which means they'll be ready to sell their stake along with the investor stake if required to give the majority to the other investors. So we look for M&A as a primary mode of exit, followed by if an IPO happens. Of course, IPO would be an ideal from a returns perspective, followed by a secondary exit, which actually is perceived as always giving a discounted price. Even though in case of Purple, we actually sold our secondary at a premium because a premium secondary can happen only if the company is profitable, company is not raising cash, and the investor desperately wants to get into the company, right? So that's exactly the scenario that happened in Purple, where somebody wants to get in desperately. The company was not raising money; it was profitable. So we actually quoted a price that we wanted, and the investor gave it to us. And buyback is a very, very rare option. An entrepreneur has to have that kind of capital to buy you back. So we still sometimes keep it purely as a theoretical kind of an option, but at least we haven't seen those kind of options getting played out while you're exiting. And to address just the second part of your question, which is like, how's the market these days? What kind of exits are giving good returns? Of course, the last year was very clearly, as you mentioned, Vamshi, in your opening remarks, IPOs were the best form of exits last year. But market may not be equally good as last year this time. So people are, postponing their IPO. So IPO may not be the best form of exit right now, but M&A would continue to be the best form of exits in the current market. So depending on the market situations, the form of exits that can give better returns keep changing.
Yeah, Vamshi, can I just add to what Vikram and Ritesh both
That's
said?
great.
Sorry, I just want to add to that because I think
Please.
there's a very important theme that is playing out, which is about the M&A theme, right? I mean, so IPOs is one piece to this larger exit story, but the M&A theme is something that's also been maturing over the last year and a half, right? So if you look back maybe 2 years, I think before that, there was still a lot of ambiguity in terms of deal structures, terms, almost standardization, right? For smaller entrepreneurs and smaller businesses to find consolidated entities that could take them over, right? Over the last year, if you look at sort of house of brands, you look at the different other models that have come up, right? If you look at sort of also the infrastructure becoming a lot more specialized, right? So you have the demand supply infrastructure becoming a lot more specialized. So today, as an entrepreneur, I think M&A is actually a very, very exciting thing for you to consider when you think about an exit strategy. And two things, right? While the science of it, so the paperwork, the deal terms, all of that is getting more standardized and more transparent, I think more and more founders of larger entities, because they are entrepreneurs themselves, they know how to connect with other entrepreneurs and they know how to give them what they need from an emotional standpoint, from a status standpoint, right? I think which is also what we've seen play at the group level, right? We are today actually a function of almost 10 to 12 entrepreneurs who've come together to join us in our mission at the group, right? And the reason it works is because each founder is still celebrated and recognized as a founder, managing his or her own team, managing his or her own P&L, but with incentives very aligned and strongly intertwined to the overall group's outcomes, right? So I think that independence, the transparency, the emotional understanding of what it is to be an entrepreneur and have folks sort of join you in the journey versus acquiring you to be part of the journey, I think that piece is extremely important. And I just want to touch upon that because I was hearing that sentiment play out with Vikram and Ritesh's remarks as well.
No. I think, in fact, I was coming to the same question, especially because you being a part of the larger entity now and, being a part of the co-founder over there, it's a completely different form of exit for you when you look from your perspective and think that, hey, when you are making up those things in your mind and thinking about this is the right time to exit, I think the options which you look at are very different. And I think those are the options which are coming up right now for every other, opportunity, I would say, right? Most of the opportunities are being built not from a traditional way, but I would say more of a disruptive way now. So when you were actually kind of getting into this opportunity to be a part of the larger group, what is it that you kind of made up your mind to say that, hey, what, this makes sense for me?
Yeah, in fact, interesting, there's a case study being written on that decision. So, we've sort of relived that decision over the last couple of months while getting that case study written. But there were 3 points essentially, Vamshi. One was very similar to what Ritesh said, right? Where do the founders see eye to eye in terms of the vision for the company going forward, right? And I think that's extremely important because, again, you don't start off building a business or building an entity saying that we're going to just shut shop and move on, right? I think the vision is much larger. So you sort of find, if you find in your partner or potential partner someone who basically gets that vision, and in fact, through his or her ambition, can amplify it. I mean, that's a match made in heaven, really, right? So I think that was the first thing we looked at. I looked at. The second thing was we examined all other options, right? And we had very detailed chats with all our shareholders, right? Because they've been part of our journey from the very beginning. And we try to reach together the right answer. So there was a lot of, I think we talked about the stakeholder conversations and management. So along with my employee, my team base, I also had very detailed chats with our shareholders on what is the right way forward for the mission for BabyChakra, but also equally, like, where does this group construct take us to? So that was the second sort of very important, very critical decision point in the entire mix. I think the third was just the vision of what we could build together going forward, right? So just to remind everyone, when we decided to partner, it was still my Glamm. It was still my Glamm, BabyChakra, Popex. It was Priyanka, Darpan, and I, right? So with three folks who would come together, three entrepreneurs would come together. And after we came together, we said, okay, can we make this bigger? Right? We'd seen this entire template of content to commerce play out extremely meaningfully. At the same time, we were being approached by other founders saying, hey, you're doing some amazing, structuring and amazing sort of, you're building out something really interesting. How do we become part of this? So then we basically thought together and said, okay, what is the right structure? Because we want to be a company of entrepreneurs and founders, right? And I think that really worked. And I think that vision, once it started playing out, was what made me really convinced that yes, we'd made the right choice in actually coming together, right? But honestly, M&As are a bet. I'll give you the flip side, right? I think in a larger construct, you have to be a lot more specialized, right? So the teams that, at BabyChakra, Popex, or MyGlamm, or the new sort of founding teams that we brought in place, right? We're now sort of focused on more and more specialized tracks, each of us. So I think there is also a certain type of a founder and a certain type of a team mentality that will work well in a larger construct and will not work very well in a larger construct. So you have to also emotionally then sort of think and introspect, right? What kind of a founder are you? What is your team set out to be? Who will fit? Who will not find fit in a larger play? So I think these are all the questions you ask yourself as you go through this journey.
Great, thanks, Naiyya. And Ritesh, just coming back to you, I think this is a little bit opposite from what Naiyya has been doing in sense of, you really didn't want to be a part of the larger journey, and you wanted to come back, get out, and start investing, and again going back to the founders and start investing in the companies. So being an angel investor now, how do you look at this now, being on the other side? I've been on that side, but I want to get your sense of how you think the journey from moving from an entrepreneur to an investor, and how do you look at this right now?
So from my standpoint, calling in, I tend not to call myself an angel investor, because the quantum of capital that I invest is so small that that it will truly not make any sense for the founder to take my capital. The only reason that they do is that I have invested in now, I think, 108 companies, and I've just realized one thing, that just be a part of missions which are extremely impactful, and that's my personal call. And this is, I call this the burnt capital, because I don't manage third party. See, managing third party capital is extremely hard. The hardest job in the entire startup ecosystem is not of the founder but of the venture capital firms. What you and Vikram are managing is I can't even, I can't even be in your position. And that is one of, it's very difficult to manage third party capital, especially in startup ecosystem of India, which is still maturing. See, there are companies that have shrunk almost 50 to 70%, and these valuations are so bizarre at times. So I think and that is why I have decided never to become a venture capital firm, or an entrepreneur who manages other people's capital for investing into startups, because that needs heavy specialization. For me, it's very simple. I'm very clear with two things when it comes to founders. I just tell them that you should be very clear, why are you raising your capital? I think whenever you get an option of what do you put in for a problem, you have two options. Either you can put your intellect or you can put your money. What founders do is, when they have more capital, they tend to invest money for the wrong reasons, for the wrong outcomes, and they're not focused. I think that is extremely important. You should know whether you are raising capital for building an MVP, because the capital that you need to build an MVP is non-hostile capital. And that is where small entrepreneurs like me come in, who say, yeah, we will invest, say, 15 to 25 lakh rupees and we don't care about the return. We have a horizon of 25 years, and that is why I was the first angel investor in Joe Stocks. I think I invested at a 1.5 crore valuation, and this was like 2014. And now Dell and a lot of partners are buying my equity, I think, at a bizarre valuation. That is why I was the first angel investor in Pepper, and now someone is buying my equity at a 500 some CR valuation. So I've realized one thing: the only way to raise capital correctly, I know I'm short of on time, just 30 seconds, is know that what kind of capital do you need for that specific journey, for building a PMF, and be very clear on your unit economics. A lot of founders raise capital without knowing their unit economics from investors who think they are investing in a business where unit economics are sorted. Because if your unit economics are not clear, do not take serious capital for acceleration of the business, because finally at scale you will never be able to make sense. And by the end of the day, these valuations of this, we are all extremely blessed to be at the right place. I don't think we deserve these valuations. We were talking about valuations which are hundreds of crores, thousands of crores. Goa ka GDP hota hai. So I feel that we are extremely at the right time doing the right thing, but we need to be very cognizant of the fact that we are at a very special moment, and we need to respect our customers and investors while doing all of that.
Saying
Thank you.
Ritesh, I think we're running out of time, so we'll just go to one last question. We'll take maybe 1 or 2 minutes each to quickly answer this. Coming back to your point and continuing on that, do you see the correction in valuation across the all stages of the startup, which means there are going to be challenges in every stage as we see? And also, what do you think are the sectors which you are bullish on in the coming next couple of years, which you think will be able to provide decent exits for the founders and the investors? So just 2 minutes each, and then we'll wrap it up.
Sure. Should I go ahead?
Yeah, please, Ritesh, go ahead.
So for me, I don't care about sectors, and that is why I end up in, because my horizon is long. I end up investing in founders like Supriya, who run Joe Stocks, founders like Anirudh, who run Pepper, who usually are not able to attract the right amount of capital. And for me, it's about that. It's better to take a 3 to 4 year journey to build the right PMF and then raise capital than from day one. And what I feel bizarre is second time founders, even like me. I've been talking to a lot of people, and they say that whenever you do your next startup, we'll write a $10 million check. And I said, $10 million is bloody 75 crore rupees. What do I do with that? So I think there needs to be rationality, and that will come. Fag end of 2022 will show a lot of bare bones when it comes to at least late stage startups. And we need to be very cognizant, especially the retail investor needs to be very cognizant and should not be a part of PR hypes for IPO gains. They should be very cognizant that startups, and there needs to be massive rationality in valuation corrections. And it's not in the early stage. I still believe that early stage is still okay, but late stage valuations need to be extremely corrected.
Thank you. Vikram?
I know we are running out of time, so I won't spend too much time. Very focused response. Yes, valuation corrections are happening. Anybody who goes to the market saying, last year I raised at X amount valuation and I've grown 3x from that, therefore my valuation should be 3x. That's not going to work. Business has to justify valuation, and the valuations are coming down. What sectors we are looking at? Very similar to what Ritesh said. We are sector agnostic, but we are seeing opportunities building health. In of metaverse opportunities are building up that we are actually going after as well. And of course, B2B SaaS businesses, again, we are seeing substantial opportunities out there as well. So these are some of the sectors that we are seeing opportunities building up.
Thank you, Vikram. Naiyya?
I mean, thanks. I have the last word as well, Vamshi. Looks like.
Yeah.
No, but I think. See, I mean, overall, I would say this is a sign of a maturing ecosystem, right? So last year we saw a lot of euphoria, a lot of buoyancy, a lot of it, of course, driven by what is happening externally in the world. This year also we're seeing a lot of corrections, but let's also be cognizant. We are also seeing, pretty, like, I mean, you look at the NASDAQ, right? You look at what's happening in Russia and Ukraine. So there's a lot of external forces again that sort of determine what's happening with the public markets in India too, right? So I think let's just put things in perspective. Long term, I'm extremely excited about the Indian opportunity. This is a place where consumer multiples are the highest, right? You're seeing 84% growth in families and households buying D2C products, right? So you're seeing very rapid category expansion as well in India and from the Indian consumer. A lot of excitement, buoyancy about that. So I think the fundamentals are very strong. What we need to think about is, ensuring that retail investors are educated about how to read sort of basic KPIs, understand what value means in specific context, right? Comps are very few, and you can't apply American comps to Indian companies, right? So I think that has been the piece of reckoning that we're all sort of going through as an ecosystem. But going forward, I think, the retail investors also getting smarter and savvier. Investment banks are getting more open and transparent. So we will see a lot of, I think, healthier IPOs go to market. So I'm positive overall. In terms of sectors I'm most excited by, of course, main D2C, FMCG, and healthcare. These are the three sectors I will keep on batting for, and I'm super excited to sort of see them play out.
Thank you, Naiyya. Thank you, Vamshi. Thank you, Vikram. Thank you, Dr. Ritesh. Really running out of time, and we have another set of speakers ready. If I could take this opportunity to thank each of you for this wonderful session on unraveling exits. And now let's get ready to welcome the new team. I want to thank everyone. For those of us who have joined in late, I'm your host.